Hello and welcome to the parallel economy, where traditional finance meets the new world of decentralization. We explore how money, power, and trust are being rewritten in real time. Just a quick reminder, this video is for educational purposes only and isn't financial advice. Always do your own research. Now, let's talk about something that has shaped every economy in history: the price of time. Long before banks or credit cards, interest was already part of human life. Imagine ancient Mesopotamia, over 4,000 years ago. Farmers would lend grain to their neighbors, expecting just a little more back after the harvest. That little more wasn't greed, it was survival. If floods came or crops failed, the lender carried all the risk. The extra return was their reward. Interest began as a simple social contract, rooted in trust and necessity. Over centuries, this small arrangement evolved into the foundation of global finance. Time had value, and trust had a price. When someone borrows money, they're really borrowing time they don't have yet, borrowed from someone who's already earned it. That exchange is what we call interest. It's the price of borrowing tomorrow, today. For centuries, this simple idea built empires and funded wars. It became the very heartbeat of capitalism. But interest has never been neutral. Who gets to earn it and who has to pay it depends entirely on who controls the rules. And for most of modern history, those rules were written by the banks. When you deposit your savings into a bank, it feels safe, right? You imagine your money just sitting there, quietly growing. But that's an illusion. Your deposit is actually raw material. The bank uses it to issue loans, buy assets, and make investments you'll never even see. In return, you get a small number on your account, a symbolic gesture we call interest. That number is your tiny share of the wealth your trust helped create. The real profit stays behind the bank's glass walls. Your trust fuels a machine. The machine creates money, and those who control the system capture the real yield. In the 20th century, a new power entered the game: central banks. They didn't just hold money, they controlled its flow. Interest rates became a lever of power. When inflation rose, central banks raised rates to slow down borrowing. When the economy weakened, they lowered them to encourage spending. Every single move changed the price of everything, from your mortgage to your groceries. What was once a personal agreement became a global mechanism of control. The public, whether they knew it or not, lived at the mercy of monetary policy. Trust has always been the invisible currency of finance. We trust that banks won't collapse. We trust that central banks will act responsibly. We trust that inflation will stay under control. But what happens when that trust breaks? History gives us the answer. In 1929, markets collapsed. In 1971, the gold standard was abandoned, and money lost its anchor to real value. In 2008, the system imploded again, not because cash disappeared, but because confidence did. Every financial crisis has the same root cause: too much trust given to too few people for too long. But in 2009, something truly different appeared. Not a new government or a new bank, but a new language, written in code. Bitcoin introduced a radical idea. What if trust no longer needed humans? No banks, no governments, no committees, just code. It didn't pay interest or have policies. It simply followed transparent rules that no one could change, rules that applied equally to everyone. Bitcoin wasn't just digital money. It was programmable trust. And from that spark, an entire ecosystem was born. Decentralized finance, or in traditional finance, interest is decided by people, bankers, and policymakers. In DeFi, yield is generated by markets and algorithms. On platforms like Aave, lenders and borrowers connect without any intermediaries. Here's how it works. You deposit your assets into a shared liquidity pool. Borrowers take from that pool by locking up collateral. An algorithm automatically adjusts interest rates based on real-time demand. When borrowing increases, lenders earn more. When demand slows, yields decline. No paperwork, no approval, no borders, just code and liquidity. For the first time, The returns from lending go directly to those who take the risk, not those who hold the licenses. DeFi doesn't remove risk. It removes the gatekeepers. Banks feel safe because they hide complexity. DeFi feels dangerous because it exposes everything. In traditional finance, you can't see where your deposits go. They move through layers of balance sheets and political deals. In DeFi, every single transaction is visible, from collateral ratios to liquidations. This transparency can feel intimidating, but it's also freedom. It gives you the ability to verify instead of just trust, but it also shifts all the responsibility onto you. Smart contracts can fail. Markets can crash. And when they do, there's no helpline to call. DeFi doesn't remove trust, it transforms it. You no longer trust people. You trust math. And when it breaks, the code will not apologize. Yield is more than just a financial return. It's a reflection of belief. When a bank pays you interest, it rewards your trust in an institution. When a DeFi protocol pays you yield, it rewards your trust in code. Both systems trade in faith, one human, one out. But in DeFi, the rules are transparent and borderless. The math doesn't care about your country, your status, or your wealth. If you connect, you participate. If you participate, you earn. That's not just finance. That's digital meritocracy. Banks are human. They rely on judgment, discretion, and emotion. DeFi is mathematical. It relies on logic, precision, and automation. One system builds stability through control. The other builds fairness through openness. Between them lies the greatest challenge of our age. Can freedom and stability coexist? Every generation must answer that question for itself. And for the first time, both answers are running in parallel. The story of interest has always been the story of control. Banks built empires on it. Governments managed economies through it. And now, code has entered the equation. Platforms like Aave don't just create new financial products. They represent a quiet revolutional redistribution of power from institutions to individuals. Why should a few central entities decide what money costs? Why not let the market itself decide through code and consensus? Each transaction on the blockchain is a small vote for transparency and participation. The shift won't be perfect or easy, but it's already happening. Technology can change our tools, but it can't change human nature. Whether we trust people or code, we're still seeking the same things: safety, opportunity, and fairness. DeFi isn't the end of traditional finance. It's a mirror reflecting both its strengths and its flaws. And like every system before it, DeFi will face crises and hard lessons. But unlike banks, code evolves quickly. It learns with every block, every failure, and every fix. Interest and yield aren't opposites. They are echoes of the same truth. Time has value, and trust has a cost. The question is no longer just how much you earn, but who you trust to define the rules. Maybe that's what the parallel economy really is: a world where money no longer flows only through institutions, but through ideas. In the end, it's not about choosing between banks and code. It's about understanding both and deciding where your belief belongs. Thank you for watching The Parallel Economy. If you found this episode valuable, make sure to subscribe to continue receiving new insights every week. Hit that like button to support the channel, and share this video with someone who needs to understand the future of money. Same principles, new rails. This is The Parallel Economy.